I'm Spence Clunie, managing partner of Ancala Partners. We are an infrastructure investment manager focused on small to mid-sized infrastructure assets in Europe. We've actually kept an open mind in the current climate. We look for overlooked or maybe counterintuitive opportunities and maybe go against the trend. So whilst there has been a lot in the media and a lot of transactions in the digital infrastructure market and in energy transition, in the last 12 months, we have done one investment in energy transition, so that's still a strong market and a market where we look to invest. But we've also done an investment in transport right in the midst of COVID. And really the rationale for that was a lot of investors, obviously with people not traveling, had looked away from transportation. So we were able to look at the transportation market and look within that market to subsectors within that market that have the key downside protections that we're looking for and a strong cash flow generation. And actually we did an investment in a company called Hector Rail, which is rail freight in the Nordics. The primary part of that business is transporting wood into and the products out of paper mills in Sweden. And we felt that that was a very resilient market, and they had mid to long-term contracts with these large paper and pulp manufacturers, and they were very integrated into their logistics systems. The company also owned the trains. It's a green transportation solution, being electric trains using green energy. It also benefits from good subsidies from governments to encourage the move from road and ships to rail. So we felt that part of the business had very good downside protection. And then on the other side, on the digital infrastructure market, which people have talked about benefiting because people are doing various video calls and needing bandwidth. We actually invested in this market in 2018 in a business called For Freedom, where we looked to invest, work with the management team that owned the business to help grow that business. And that growth was to come through CapEx to develop into new business parks, and it was also come from bolt-on acquisitions. But with the change in the market, it was almost like every infrastructure investor wanted to have a digital infrastructure asset. We saw prices for those types of assets go up quite significantly, and the demand for those assets go up quite significantly. So in that situation, we felt our opportunity to grow would be harder. People were looking into smaller assets to access that market. And we therefore then felt, given the risk return that was present in the market, that we would actually exit our investment given the market dynamics. But I think it's important that one looks at, first of all, the underlying dynamics of the business, so the cash flow, sustainability and the downside protection on one side, and on the other side also looking forward, what are the opportunities for the business. And if someone is willing to pay today for all those future growth opportunities, then maybe we exit, and if we can enter at a good price, even in a difficult market with COVID and transport, then it can make sense to do that. So really looking at the risk and the entry price and what we can do with the business as driving what we should be doing in these particular sectors. Biggest challenges in terms of finding new opportunities, I think it's important to take a very disciplined approach to find the right investments, and that involves doing the macro level research across the infrastructure sectors and the geographies, and then going below that and saying which subsectors have the downside protection and the cash flow long-term cash flows that we want. Looking within transport, obviously, assets that have consumers have been hit. Consumers, as in airports and roads to an extent, have been badly hit. Whereas you can find these niches or these pockets, as in rail freight, where they haven't been hit as much. So it's then doing the work to analyze that, and then doing the work to then approach them directly and see what there's opportunities to do that. So that continues to be challenging, and I think it just takes time and effort. I mean, clearly one of the key themes are continuing low interest rates, which will continue to attract investment into infrastructure from pension plans, insurance companies, and the like. But from our point of view, it's looking at not the direct, be it renewables, not the direct, be it fiber, but looking at areas that are maybe where other people are looking that can still benefit from those tailwinds.